Within taxation, one specific factor that I want you to note down is going to be DTAA, which is also known as Double Taxation Avoidance Agreements. So DTAA, which is also known as Double Taxation Avoidance Agreements, these are agreements created between two countries in order to ensure that businesses can happen smoothly between those two countries. And that is why a lot of companies that are global, for example, let's just say Google. Google is based out of US, Google Inc. This is a US based company. They of course have a division in UK. They have one in India. And I'm pretty sure they would have the same in 100 plus countries overall. Now, this entire structure is possible only because of one important factor, which is Double Taxation Avoidance Agreement, which is in place between countries in order to ensure that whenever a business is operating in one place, they can also operate smoothly in some other place without any frictions whatsoever. Otherwise, what will happen? Let's just assume that there is no Double Taxation Avoidance Agreement. Can you tell me what is the rate of tax in UK for corporates? Must be 35%, I think, 30-35%. Is that correct?
Yeah, I think so, yeah.
Yeah. So let's just say there's a Google UK. In UK, let's just say there's a Google UK company, right?
Yeah.
What they will do is, let's just assume that they have a $100 million in profit. The problems that occur is that Google in itself is a company that is based out of US, which means on all the profits that it generates, it is supposed to pay taxes in the US, the Google. It has also formed or floated a subsidiary in UK. And let's just assume that they have made a profit of $100 million in UK. The biggest problem that arises as a result of this structure is that now what will happen is they will have to pay in UK 35% taxes, which is 35 million. And then when they go back to US, they will say, you know what, I don't care about the taxes that you have paid in UK. I don't recognize that as a country. Or, I mean, that's of course taking a little far. But I would say the US entity are going to say, I don't recognize any taxes that you have paid over there. You are a company which is actually domiciled out of US, which means you have to pay taxes here. So here they will say that pay the incremental 25% taxes here as well, which comes to 100 million into 25%, which is 25 million. So the overall taxes that it will have to ultimately pay will be equal to 60 million. And this absolutely discourages any company, let alone Google, any company for that matter. They would not really want to do a business in this kind of a situation because you're taking a lot of risks and ultimately your 60% of your profits go down because of this kind of a structure. So, and sometimes things are even more complicated. Sometimes it can so be that there's a US entity which has a subsidiary in UK, which can have a subsidiary in India. In this situation, if there is no double taxation avoidance, the company will pay 25% taxes in India, followed by 35% taxes in UK, followed by another 25% taxes in the US. And if you count it in total, it becomes 85% in total taxes that you have to pay. If I introduce another country in this entire chain, you will pay more in taxes than the overall profits that you have generated. So in order to avoid this kind of a situation from happening, multiple countries across the globe which recognize each other would usually have a double taxation avoidance agreements in place, which is to say that US would say that, okay, if you have a company in UK, if you have paid taxes there, I would allow that taxes paid as a deduction from the overall calculation of taxes over here. So how it is actually structured is, let me just show that to you in an Excel. I think that'll be a little easier. Let me open up an Excel. And pay close attention over here because this is where a lot of friction sometimes happens, right? So let's just say Google is a US based company having operations in UK, India and Sri Lanka, right? Let's just profits and tax rates. Assume that US has double taxation avoidance agreement with all the three countries. That is an assumption that I want to give you. And let's just say in UK, in India, and in Sri Lanka, let's just say it earned 50 million, 120 million, and 75 million. And US tax rate is 20%, UK tax rate is 35%, India's tax rate, let's just say it's 25%, and Sri Lanka's tax rate is, let's just say 15%. So this is where complexity starts kicking in, and you have to be a little careful about how to go ahead with this structure and this question. So yeah. So over here, DTAA, what it tells you is that if at all there is a double taxation avoidance agreement that you have in place with some other country, they will say, okay, whatever taxes that you have paid over there will allow you to offset those taxes when you're computing the taxes in US. So actual calculation from a IRS perspective, what they will do is they will say, okay, taxes paid abroad, taxes to be paid in US, which is domestic, and then let's just say they will look at the difference, pay if this is higher. Let me present it to you in two different formats, and then give you a shortcut which will always give you a right answer. So taxes paid abroad will be 50 multiplied by 35%. They have already paid this amount as tax in the UK. Assuming that it was so what the next step that they say is, okay, whatever you have paid in UK is fine, forget it. Tell me what is it that you would have paid had you been in the US. So they say that assume that you're not abroad, assume that you're a part of my own country, assume that you're based out of US itself. Now calculate the taxes that you would have paid. The calculation will be 50 multiplied by 20%. So had this 50 million, in a sentence if I have to say, had this 50 million been earned in US itself, the taxes would have been 10. So they have already paid 17, and if they were in US, they would have had to pay 10. They would have had to pay 10, they've already paid 17. So it's basically saying that they've already paid a higher tax than what they would have otherwise paid. So in this situation, the difference between the two is going to be 7.5, but the actual payment, if you see, it's going to be negative 7.5. So you'll have to pay 0. So it's the minimum of the two, either the difference or 0, whichever is, maximum of the two, whichever is higher. So same, if you apply the same logic, let's just do it a couple of times and you'll pick up pace. So first thing is to calculate the taxes that you have already paid in India. So you have paid 25% taxes, which is $30 million in India. Now forget that you are in India, assume that you are in US. If you were in US, you would have paid 120 million multiplied by 20%, which is 24. You have already paid 30. If you were in US, you would have had paid 24. Because you have already paid higher, again, if I drag this formula down, you will be required to pay 0. And assuming the same calculation once again, if I do this in Sri Lanka, they have already paid 15% taxes in Sri Lanka. Had they not been in Sri Lanka, had they been in the US, they would have had to pay 15. So now the calculation becomes a little tricky. So they'll say, okay, you have paid 11.25 in Sri Lanka. Had you been in US, you would have had to pay 15. Because you have paid lower, pay me the delta. So that is how it will be structured, and they will be required to pay 3.75 in this situation. So maximum of this or 0 is what it is paid. The idea behind DTAA, the logic behind DTAA is very simple. Pay the higher of the two tax rates. So that is how it is structured. You will always pay higher of the two tax rates, which means between 35 and 20, 35 is higher. 25 and 20, 25 is higher. 15 and 20, 20 is higher. So you'll end up paying this. So if I structure it, will be 20, 20 and 20. Here you will end up paying 20 in total. But this is just a shortcut. you'll also have you'll have to be a little careful that the way that it is calculated is you first pay 35 here, and then you calculate that there's a zero liability that arises here. Then you calculate the 24 you've paid here, and then you calculate the liability here. And similarly, you do the calculation here as well. So the total amount that you pay in terms of taxes, if you see, is this. And if you look at the, sorry, there's something off. And now if I calculate the rate of tax, of course, I'm doing the same thing again. You will come to the same rate. So here, oh no, sorry, the initial. Yeah. So if you see, the tax rate will always come to the same number, which is 35, 25, and 20. It's just that it is bifurcated into two.